when housing affordability deteriorates, there is not this immediate move to where, mortgage rates went up X amount and pushes up the new payment X dollars. So now prices have to fall X amount to equalize that. That's just not how it works. Housing has went from one of the most affordable markets in history to one of the most unaffordable markets in history in 3 years. Well, so one reason that people are wrong is they'll look at things from like a nominal dollar. So people always think things are unaffordable.
Welcome back to the Reside Platform podcast. I'm really excited because we have Lance Lambert here. In fact, I just talked to him yesterday. I follow him on X, formerly Twitter. He has really been trending, in my mind, hugely and massively because of the constant content he is delivering on the housing market. Ever since interest rates have jumped up to 8%, this guy is at the forefront of what's going on. This guy is the co-founder and editor of Resi Club, and we're going to find out more about that. That's a groundbreaking media and research company dedicated to in-depth tracking, reporting, and analysis of the U.S. housing market. Normally, we're interviewing top broker owners, team leaders, but for the first time, we're bringing in someone that's studying the market at a deep level so that you guys can understand it at a deeper level and deliver that to your agents. He has a reputation as the nation's leading data journalist, as a beat writer in the residential real estate space. He served as a real estate editor of Fortune magazine and worked as a data journalist at Bloomberg and Realtor.com. Lance, welcome.
Yeah, thank you for having me on. I'm really excited for this. And like you said, this is a really interesting time for the U.S. housing market, to where not only have we seen affordability to deteriorate to levels that we haven't seen since the early 80s, which will happen when you have a price shock followed by a subsequent rate shock, but we also are in an environment where the amount of inventory on the market is at historical lows too. And we have very tight resale. And so a lot of what I cover is a tailwind and a headwind that are both very big, and they are pushing into each other. And the tailwind that's pushing in a positive direction for the market is the lack of inventory, right? That's pushing prices up. But the headwind is this deterioration in affordability, to where not only is it, stretching people thin to buy homes, but a lot of people have just lost mortgage eligibility altogether, right? And so that's the headwind. And everything in the market trickles down off of those two things, the tight resale supply and the deteriorated affordability. And how we've seen that play out is the biggest hit has been on existing inventory transactions, right? The amount of transactions occurring in the market is way down because churn has been sucked out, right? Somebody who would take their home and sell it to buy a new home, that particular person is pulled back because, one, they don't want to give up the 2, 3, 4% mortgage rate, but two, a lot of them aren't even eligible to get a mortgage now, right? At these prices and these rates. And so even if they sold their home, they couldn't afford it. And so the churn has just been pulled out of the market. On the new construction side, what we've seen there is last year they took an initial hit as there was a rate shock in the market. But because builders had the bigger margins, especially the bigger builders, what KB Home CEO told me they did is once they were able to run down their backlog, depleted a bit from those pandemic highs, coming into this year, they then did the affordability adjustments on price and rate buy downs and those things and went out and met the market. So new home sales have recovered a bit from last year, while existing is just down a lot because the churn is just sucked out of the market. And on national side, on the pricing, we saw the market for 6 or 7 months destabilize, especially out in some of the western pockets of the country and these boom towns. But we've since seen a stabilization in a lot of the pricing as buyers earlier in 2023, there was just enough acceptance of like, hey, rates are higher, still very tight resale inventory, and the fundamentals on the side of low vacancies and little stress among homeowners put the market back into stabilization on the pricing front. But as you look at it, while we've kind of stabilized on the pricing, it's still a very unhealthy market because affordability has just deteriorated to these levels as we've gone through this Fed rate hiking cycle. And it'll be interesting to see, next year, do we finally get some, a recovery in the bond market, which could push yields down, is really the hope for a lot of the transactional side, is that we could kind of come off of these highs as the Fed rate hiking cycle hit, we went through it and inflation is decelerated. Now, can we get some relief on the bond side and get yields down a bit? I think is the hope and what we're kind of watching for, if there will be any type of bond rally next year.
Yeah, in the real estate sales environment that our audience is part of, broker owners, team leaders, real estate agents, I liken it to a traffic jam of sorts. It's not, the lack of inventory is slowing down the turnover.
Mm-hmm.
When people ask us how is the market doing, they're usually asking, how is the market for me?
Yeah.
But when you ask a real estate agent, how's the market doing, they think about themselves. And a homeowner wants to know, is their home value going to go up or go down in the future? How is it? Is it going to go up or going to go down? A real estate agent is thinking, is my bank account going to go up or going to go down?
Yeah.
Because we make money when it turns over. And so right now in this industry, our industry, the turnover is really low. Sales are down. And I would like to know what you're seeing in marketplaces. Sales are down with our clients across the board in their markets. There may be some anomaly here or there. And so if sales are down, the amount of commission and revenue opportunity is down. That pie is smaller.
Yeah.
And so that leads me to, the lack of supply, which is causing fewer sales, and the churn. And I've never called it churn, but let's dive into churn. What is churn?
To me, churn is this idea that as the market rate for mortgages gets so far above the effective rate, what people actually have. So right now, the effective rate for mortgages in the U.S. is 3.6. If you take every mortgage in the U.S., it comes out with a 3.6% mortgage rate. That's according to Bloomberg. Now, the market rate today is what, like 7.87 on the average 30-year fix? So that huge gap puts people in a place where the trading cost of moving out of their home to buy something new is substantial. And that's even if they could afford it. And so to me, I think churn is what's disappeared from the market. And that's what's pushed down the resale transactions, is just people not selling their home to buy something new unless they absolutely have to. Or, they're just so rich they don't care. Maybe there's still something.
Well, there's something here, right? So let's dive into this further, because in a residential real estate office like mine, churn is what we want. We love that. We get to list the home, they sell it, they buy another. That's 2 sales in one. That's part of the marketplace. So there's churn where you move up in the market. So you sell and you move up. Okay, well, they're getting hit hard, right? Because you're selling that 3.7.
Yep.
You no longer get that. You don't get a ticket with you. And then you have a higher cost. So why would someone do that? You mentioned a life event. They're forced to. Or it's really the pain of staying there is higher than the desire, right? So extra have another kid, to go from 1 kid to 2 kids to 2 kids to 3 kids. Family member moves in, kid moves back in from college, health, the functionality of the home, split level is no longer conducive for my knees and my back aging in place. So as real estate agents and team leaders, we have to look at these behavioral things. Now, there is still some churn, though. I want to get your ideas where they sell and move down because of the tailwind over the last few years. They have lots of equity.
Yeah.
And I don't know if you've reported on X, all your tweets, they're awesome. You got to follow Lance. Look him up on X and Twitter, is the amount of people that don't owe anything.
Yeah.
Like no mortgage.
40%. It's 38% of the country of homeowners they don't owe anything.
Now, why is that?
The reason that there's so many people who don't have a mortgage is because it's people living longer, and the fact this huge generation of the baby boomers is now getting, they are in retirement, a lot of them.
Mm-hmm.
So, they paid off their homes. And there was also, in my view, and this is a theory, I can't quantitatively prove this, but I think there was a cultural aspect where out of like the housing bust and also like the Dave Ramsey type people, where a lot of people took extra cash and paid off their homes. And I think that was very true for a lot of like the older Gen Xers and baby boomers. And so it accelerated their swing to 100% equity. And now, home values have really ripped. And so they're really sitting on it.
Because that restricts it. Once you own it outright, you hold on to it longer.
Yeah. Well, yeah. So there's two things at play. There's the one, which is, like we talked about just before, but also, so the reason that number has gotten so big to 38% of homeowners have no mortgage is one, that, the baby boomers are such a big generation and they're living longer. So the pie of homeowners leans older now, and older people are more likely to have their home paid off, right? But a reason some of that isn't churning is because the older people get, the less likely they are to churn, right? The inventory turnover for people 50, 60 is much less than people who are, let's say, 35 and have that starter home and now have 2-3 kids, and they need more space.
So this is interesting. It would be interesting to know what the average age of a homeowner is. Listening to you, I'm going to come to the conclusion that has increased. The average age of a homeowner has increased over time, over the last 10 years.
Yeah, the average age of homeowners has increased, and the average age of first-time buyers has also increased. Across.
Yeah, right, because it took them longer to get in there. Now the supply and affordability. And so, where I bought my first home at 25 years old.
Yeah.
That's not that likely anymore.
Yeah, it doesn't happen as much anymore. Yeah.
And I think there's something I want to talk about, generational gaps here and the millennials, and we'll get to that in a minute. But I want to dive into this churn even further because I think people need to understand this. So 38% of people don't owe anything. Your theory is there's a shock after that recession, trauma of sorts.
Yeah.
That, a shock wave of memories that they never want to experience that again. Even if they didn't experience it directly, they experienced it indirectly with their parents, their grandparents, their friends, their family members. You were talking about off air, your father, right?
Yeah.
Went from something to nothing.
Yeah.
I
on his business of home additions. Yeah. And he was doing that in the mid 2000s. And I would say around 2007, his business went from, what he was doing, it fell 100%. Just nobody was doing home additions anymore. And that was even before the crash actually happened. There was that slowdown that was starting to work in over time. But yeah, it was that psychological effect and the cultural effect also of like people like Dave Ramsey are like, debt is bad, don't have debt, pay off your home. I think that accelerated the swing, coupled with demographics, more people being older, living longer. And that has just led us to this point where mortgage debt as a share of home ownership is much smaller than it used to be historically. And now we have all fixed rates too. So we've gotten rid of variable rates, and people have, or the number of people with paid off mortgages is much higher too. So it's just a different housing market.
Yeah, it's a different housing market, and understanding the psychology of someone that has a home, and a lot of baby boomers own more than one home.
Yeah.
They don't just own one home. And I wanted to talk to you about the effect of vacation rentals, Airbnbs. Because if there was an area of speculation and sexiness and sizzle was buying an Airbnb, especially with the tailwind of COVID and those bookings were through the roof. Have you looked at that at all?
Yeah, so the economics there is really interesting, where during the pandemic, cruises are gone, international travel is gone. People also can work from wherever the hell they want to, and they want more space. And so we saw was an acceleration, a huge acceleration in demand for Airbnbs once the first few months of the scary lockdowns ended and like the really high unemployment initially. Then we saw a huge surge up in short-term rental demand. And at the same time, we saw a housing boom take off because there was an accelerated demand for space and for housing because of work from home, which was aided with low rates and STEMI money. And then home prices are ripping. And so if you're sitting there and seeing these people who are Airbnb hosts just raking in the cash because Airbnb demand has soared, and then, oh, by the way, their home value is ripping, it creates that FOMO effect. And so this was like the bigger pockets FOMO effect. And we saw all this demand rush in to buy properties to turn them into Airbnbs. So as this moved along, what we started to see happening is that, the economy's reopening. The lockdown restrictions are gone. Cruises are coming back. International travel is coming back. All these people who bought these properties to turn them into Airbnbs, they're now moving into the market. So we saw the opposite of the supply and demand effect. Whereas in the initial part of the pandemic, demand has soared and outstripped the supply of Airbnbs, to now that demand was coming down a bit in some markets and the supply of Airbnbs was coming in. So what has been occurring in my view is, and it's hard to really get a good feel of this because you'll have the group who is like, this Airbnb stuff is a bunch of nonsense. Nothing's happening. Look at Airbnb's earnings. They're still going up. And then you have the other group who's like, this is Airbnb bust. Everything's falling, crashing. I think the truth of what is actually happening is there's a short-term rental correction occurring, and it's very bifurcated by markets and submarkets. And what really needs to happen is that some of these Airbnb hosts who jacked up rates to really high levels during the pandemic need to pull them back. And that's how they'll get the vacancies. So as they pull back, you'll then have some of the Airbnb hosts who are like, I'm not making enough money doing this, right? So they'll have to face a decision. Do they sell the home or does it become a long-term rental? And so I think we're going through some of that, and it takes time to kind of play out. But, I think it's a necessary thing in the market because the short-term rental hosts who controlled their own charges really took advantage of the pandemic window and took them to unsustainably high levels, is my personal view. And what I think is occurring as I start to see some of the numbers of the rates come down. And, I started using Airbnbs in 2015, and I would use them all the time. I think since 2020, I've completely stopped because anytime I travel and I check the rates, the hotels are so much cheaper than the Airbnbs. And it feels like there's been some distortion there in the market, and that it'll take time, and economics always wins. And so I think we're watching it play out, but I think this is a short-term rental correction, and that when we look ahead several years, I think what we'll say is, that's a short-term rental correction. And now we finally know what a correction in the short-term rental space looks like. And as the real estate cycles play out in decades in the future, we'll probably have more of them. They just haven't had a downturn.
Yeah, they haven't. And
we're seeing what it looks like now.
That's a really interesting opportunity for real estate team leaders, broker owners to watch. It depends on the marketplace, but the Airbnb people either own it outright or have a really low fixed rate.
Yep.
So they're going to hold out as long as possible. But I personally own an Airbnb. I've had it for many years before the tailwind. During COVID, it went up 40%, 50% in bookings and rate.
Yeah.
I'm back down to pre-COVID levels.
On rates?
Yeah.
Okay. See, that's the short-term rental correction. Yeah.
That's
And
the rental.
and AirDNA and some of these places like to act like it hasn't been happening, and it very much has. And so I think one of the things. So here's the problem with the media aspect of the story is the AirbNb and the industry groups deny everything. They're like, look at these macro numbers of everybody aggregated, the total revenue's moving up. And then you have the other group who's like, oh, because of this, there's going to be so much supply flooding on the market. And it's like, well, the most likely thing is booking revenue comes down, those daily rates come down, or there's more transition from short-term rentals to long-term rentals. That's my view.
Well, I have a property management company too, and I've seen more people going directly to long-term than ever. So they're not even considering listing it. Normally they would consider selling first as their first option, renting second, because who wants to become a landlord if you're not a landlord?
Yeah.
Going from not a landlord to a landlord, you're like, whoa, that doesn't sound like something I want in my life. The return on hassle is not good. You got tenants, you got evictions, you got new laws, new things you got to worry about, maintenance and repairs, right? It's easy for a landlord to get another rental. That's easy.
Yeah.
I'm already in the space. But I'm seeing more people enter into that space locally than I've ever seen before without even exploring selling.
Yeah. And so I was talking to Amherst CEO the other day, and they own 44,000 homes in the country. They're one of the biggest institutional owners of homes. And what he said is, it's essentially the trading cost. And if you break it down from the lens of like an economist, that home and that mortgage, it might be worth $125,000, $150,000, $200,000. And so while that person might not think about it that way, I think they know that rate was a great deal, and they're going to try to hold on to that property even if they can't short-term rental it. So what you're telling me is what you would think would occur in a short-term rental correction in theory. So it makes me feel a little good that what you're seeing on the ground is kind of reflected in the theory of how it would play out.
And same with the Airbnbs, like, as you put, they go from a short-term environment to let's try to see if we can make the numbers work on a long-term environment before we consider selling it. They're not making that leap to selling it, but I think that's going to happen case by case.
Yeah.
And what you're seeing in some areas, like I think, I could be wrong, British Columbia, Vancouver, BC, where regulations change and prohibit short-term rentals.
Yeah. And so I've talked to some agents where they're not getting a lot of business right now, but a chunk of it is the short-term rentals. Phoenix is an example of somebody told me that. But it's not something to where it like floods the macro level of the market. But yeah, I think that is one of the areas, if you work in a transactional job, that's like one of the areas where you can kind of shake the tree. Like there is something to be,
There's something there where one of my friends just posted on Facebook that they have an Airbnb in Phoenix. He lives 2,000 miles away. I had no idea he owned an Airbnb in Phoenix.
Yeah, this is that bigger pockets hype.
Yes. And so what you're seeing is I would as a real estate looking for opportunity, I look for people that own more than one Airbnb, because there was a trend where it was like, how many can you get?
Yeah.
Because look at me, I have 10 now. And so they might be willing to offload a couple of the non-performers. Now, here's what it may do though. Airbnb's second homes typically are on the higher end of the spectrum.
Yeah.
Right? They're not entry-level homes unless you're a condo. So if they do hit the market, they're going to be hitting maybe the higher end homes, higher price points. What are you seeing in terms of tale of two markets? Is there a high end and low end?
Absolutely.
Right?
Absolutely. And it goes back to the thing we talked about at the beginning, which is churn. And so if you just don't have the move up buyer, right?
Mm-hmm.
Move up seller and buyer. And so you don't have the supply from them, right? And the supply from them is often to the bottom half of the market, and you don't have the move up buyer's demand. So that right there softens demand a little more, and it pushes supply down even a little more on the lower end. So weakens the top end, and then in theory is a tailwind for the bottom because there's less supply. And then you also have the fact that when housing affordability deteriorates, there is not this immediate move to where, oh, mortgage rates went up X amount and pushes up the new payment X dollars. So now prices have to fall X amount to equalize that. That's just not how it works. But what does happen is that expectations start to shift because the affordability is just so pressurized and they just can't make the numbers work for themselves. So they pull back their expectations. And as they pull back their expectations, they're more buying at the bottom of the market, right? And less at the top. So the top of the market always takes a deteriorated rate environment harder in theory than the bottom. So we should, if economic theory for housing is correct, what we should be seeing is a weaker top and a stronger bottom, given all of the variables in the housing market. Is that reflected in what you're seeing?
Yeah, I'm seeing that too. So going back to the churn, now you have the downsized people, the baby boomers or older that are downsizing into that lower price point because they can't.
And that bit is a whole other, that just accelerates the trend that should already be true. And that is kind of like one of those things where every housing cycle is unique, and getting to a housing cycle where there's so many boomers who own homes with so much equity, they're going to do things that aren't normal of housing markets. And so, yeah, I think it's, that they are the unique factor, one of the unique factors in the cycle.
But their style of home specific, though, they're not going to downsize into something with repairs and maintenance heavy. They're not going to downsize into something that is multiple stairs, and so the demand for 55 and older communities, certain living in place, last life cycle, life stage of a homeowner, I think the demand's going to be strong over time. But again, they're holding onto their home longer. Yeah. Now, then you have these millennials coming on saying, when is it our turn?
Yeah.
I mean, I don't know if you're a millennial.
I am.
Yeah. So I hear that sentiment, wait a second, we missed the first boom and the recession. We're glad about that, but we also have trauma. And so we kind of stayed away. We have really high student loans. We're finally getting our feet together, our careers together. And then we have this COVID thing, and we got outbid by everybody.
Yeah.
Or if we did get a house, we're not happy with it because we had to settle, and they feel stuck.
So one of the things that I got into sometimes in 2018, 2017, where I was pushing back at other journalists who would write stories about housing affordability being so bad and millennials can't afford homes. And while individually it's probably very true, a lot of people couldn't afford homes. And there was, the effect of California and the West Coast affordability,
sure,
was really moving in a deteriorated level. But on a historical basis, that 10-year period was the most affordable housing market ever. I mean, even 2020, that is one of the most affordable housing markets ever. Now, it might not feel like that if you're in the western parts of the country where price to rent ratios and stuff have really gotten into a deteriorated level during the low interest rate ZIRP era and the tech boom that occurred for that 10-year period, 2010 or started before 2010, but that whole decade, right? But it was true that housing affordability on a nationally aggregated level was the best decade ever from 2010 to 2020. And then what we have seen over the past 3 years is housing has went from one of the most affordable markets in history to one of the most unaffordable markets in history in 3 years. So right now, a lot of what the market is feeling is still shock. There's a shock of how fast things have deteriorated on affordability. And that shock effect, I think in theory means that the churn side of the market is probably about as suppressed as it can get. And then as there starts to be some acceptance where it's let's say that rates go down to 6.5%, right? And they hold there. at that point, people were like, you know what, those 4, 3, 2% rates, those aren't coming back. I have more kids now. It's time to move on with my life. So you start to get some of the churn back into the market from acceptance. And so you would think that this period we've been in is, this very quick move to deteriorated affordability. There's still a shock effect in the market. And as that starts to fade a bit and normalizes in that sense, that some of the churn comes back into the market. But yeah, going back to the point earlier, it's crazy to think about, but millennials actually had the opportunity to buy into one of the most affordable housing markets ever. And the problem is that, it was getting harder to buy earlier in your life as people were taking on like more education. And there was the great financial crisis that kind of set people's careers back a bit. And so what you ended up getting was a big group of millennials who bought homes at the most affordable market in history. And then you have the other half that has not. And they've really deteriorated on the affordability side to what they can buy into. And so when we talk about a tale of two markets, it's also a tale of two home ownerships for millennials, where you have the group that, pretty much won, and the group that now is, I hate to say it, but they've essentially lost in an economic sense.
Well, there's a couple points I want to dive into here. One, just briefly, serving as a real estate editor for Fortune, data journalist, Bloomberg, and Realtor.com, right? I heard you say in 2019, you were pushing back against people saying it wasn't affordable, and it turns out it was the most affordable.
Yeah.
Well, when you look at MSNBC, Yahoo.com, wherever the consumer's getting their information on the housing market, it is, as an expert in the local field, the local market, it's never right.
Yeah.
Or where is why are they wrong?
Well, so one reason that people are wrong is they'll look at things from like a nominal dollar amount, right? So it's like, okay, yeah, 2019 home prices were the highest ever. Yeah, that's true. But the other part is that people have this sense and this belief that things are always unaffordable. So no matter what prices things are at, people always think it's unaffordable. They do for everything. I mean, they'll be like, well, it used to be X, Y, and Z back in the day. So people always have this bias to thinking things are unaffordable. And that's why it's important to look at things in like inflation adjusted dollars and use affordability index.
Oh my goodness. So you don't understand what you're doing right now. You are giving people a script or a dialogue or talk tracks that people can use to their consumer. Understand what Lance just said. The consumer always thinks it's unaffordable. So if someone's looking on my website or wants to do business, right, but they push me back, they're not quite ready. You have to understand this, Lance. In my world, they're always just looking. They're always not ready. Because in their mind, it's unaffordable. And then when they go to get guidance, who do they get guidance from? Their parents, their uncle, their brother. And guess what? Home prices were probably lower back then.
Yeah.
It's like everything, you hear this all the time with inflation, like everything's so much more. It's so much, and it's always been that way in my life. Oh, everything's expensive. Everything costs more and more. So that's a good point. And I think how you handle that, just for people as a real estate trainer, is like, I know you think it's unaffordable. I know you think everything's expensive. Just approach it with that. Lower the sales skepticism. Yeah, I know what you're thinking in your head.
Yeah, and
let's actually look at the numbers.
Yeah, exactly. And so people always think things are unaffordable. And so that's why that whole decade of like, oh, millennials can't buy homes, blah, blah, blah. That's where it came from. But if you looked at the affordability indexes, like NAR has a great one, and the Atlanta Fed, you could Google Atlanta Fed housing affordability, you will see that, 2010, 2019, 2020 were really great affordability years. And actually, 2021 was still really good affordability year. Now, I'm talking about mortgage rates, incomes, and
Right.
prices, the three big kahunas all together. And so now what we've moved into is actually a market that by a historical basis is very unaffordable on those 3 points together. Like people, taking out mortgages at today's prices, today's rates are getting stretched thin relative to history. But if you look at people who bought in the other periods where it was like this, the early 80s, the late 70s, I mean, those, it played out to be great decisions for them long term. Because while, they were stretched, initially, if their incomes rose over time and they had that fixed debt, and as their equity grew from house prices moving up over time, it put them into a good position.
I also think about, what's the old framework. It's like a Jeff Bezos framework. What's likely not to change versus what's going to change. And every time I see people post on Twitter about housing and supply, I always jump in their comments and nobody comments me back. Zoning.
Yeah.
Zoning restrictions. And I'm coming from Washington State, and it's different based on your county, your city, your county, your state, your province. But as a real estate professional, understand the zoning, because that is restricting supply in my local market greatly.
Yeah.
And the regulatory compliance to get into just to build in some of these states is becoming really hard. And I see that restricting supply for the long term.
Yeah.
Which gives me confidence that prices, as though they might go up, they may go down. I don't think they're going to go down as far as they would, because it's just harder to build. You work with builders. What's your sense on my take on Growth Management Act and zoning?
I think that's right. Yeah. I think it's zoning. And then also you've seen builders really pull back, and maybe this is less in your market, but more nationally, really pull back from building the single family homes that are the smaller ones and the entry level, and even some of the manufactured homes. Because once we tightened lending standards coming out of the financial crash, we pretty much took a segment of the market and said, you can't buy anymore. And so builders, who used to build for that market, and they weren't building super expensive homes or in the top markets for them, but, the places they were doing it, they stopped. And so now who you're kind of starting to see step in to build those homes for that market? Institutions. So the institutions are now taking over for the market we priced out and builders couldn't build for the past decade. It's taken the market time to get back into equilibrium, but the result of the regulations that were passed following 2008 will, in my opinion, continue to lead to more and more institutional home ownership in the build to rent space, is my view.
Yeah. Build to rent.
Yes, the build
to rent. And so even the builders, I like to get your take, transitioned into apartment complexes. Traditional residential builders also started dabbling into resident apartments, higher densities, and then holding those as rentals or selling those off at low cap rates, which is really high prices.
Yeah.
Around the areas. And so they weren't utilizing all their resources for single family homes.
Yeah. But now I think it's going to be more build to rent and single family and smaller. I think we'll continue to see,
which is interesting. So there's going to be more renters than ever, or maybe not ever, but when does the tipping point come in where the status of home ownership is so great because it's hard to obtain? Is that status going to be there, or is that going to go away?
So one thing we've seen is actually home ownership has continued to tick up a bit, right? And one thing is we're not seeing a lot of churn out of the market, people selling, and so it's kind of holding stagnant, right? But if we get to a point where, as the baby boomers and those before them are passing away, and we start to see that shift occur, if that starts to lead to a real steep fall in home ownership rates, which might be possible, I think we'll then start to see more blowback there. But I think that's where we're heading. And so, and I think people know it. I think there's a sense of people knowing that's what's going on. So home ownership's very high still, but there's probably going to be some rolling over there.
Well, this has been awesome, Lance. Thank you so much for joining us on the podcast. And last minute, I got a hold of you yesterday. You jumped on today. You're all in all the time. Everyone, find Lance Lambert on x.com and also follow Resi Club on as well. How do they reach you? How do they follow you beyond that?
Yeah, so they can follow me on Twitter at @NewsLambert. I also have Resi Club's Twitter handle at Residential Club. If they Google Resi Club Analytics, they can go to my website and sign up for my free daily newsletter that gets emailed out every day. And then I also have a premium tier that's 3 additional subscriber-only stories, and it also includes data in my house price tracker and my house inventory tracker. And so it's things like house prices from Zillow, Freddie Mac, and then also active listings, new listings, and days on market for metropolitan areas, counties, and zip codes, all there. And it shows things like year-over-year shifts, 2-year shifts, 3-year shifts, all of that good stuff.
Yeah, and you do an amazing job mapping it out for everybody. And I highly recommend everyone go there and follow Lance, because it is less of an emotional decision. We have to be able to have data-driven decisions, meet with our clients and have consultations with them. You're going to be with your clients longer. Take the time to have these discussions, where before you weren't with your client for more than like one home. You didn't get to know anyone. You didn't get to add any value. I don't think you acquired a client for life in the last 2 years. You didn't have enough time. So the opportunity now is you have these clients, you can work with them and show a level of expertise that differentiates yourself. And then you're going to have clients that are going to use you and recommend you for decades. So that's the opportunity. I know it sucks because we don't get as many sales, but future sales will be huge if you follow Lance and get the right information. Lance, thank you for joining us. I hope to have you back on the podcast another time.
Yeah, this was great.